Let me ask you this. Why is it that two people can start with the same amount of money, invest over the same number of years, yet end up with completely different results? One builds wealth steadily, while the other struggles, makes losses, and eventually gives up. The difference usually isn't luck. It's discipline. It's mindset. And above all, it's about following the right principles. Today, I'm going to share with you 3 timeless investing principles that can help you not just grow your money, but also protect it from common mistakes. And along the way, I'll share real stories, practical examples, and some of the psychology behind money, because investing isn't just about numbers. It's about how we think. Principle 1, never lose money. Warren Buffett once said, "The first rule of investing is never lose money. The second rule is never forget rule number 1. At first, this sounds obvious, but let's dig deeper. Losses hurt not just financially, but mathematically. If you invest $10,000 and lose 50%, you're left with $5,000. To get back to $10,000, you need a 100% gain. If you lose 80%, you'll need a massive 400% gain just to break even. That's why protecting your capital is far more important than chasing high returns. Think about it like building a house. Before you worry about how beautiful the furniture is, you need to make sure the foundation won't collapse. Losing money is like cracking that foundation. It makes everything harder to rebuild. And here's the trap. Most people lose money because of greed and fear. They chase the next big thing, whether it's a hot stock, a trendy cryptocurrency, or a friend's can't-miss business deal. They invest without understanding, and when the price drops, fear takes over and they sell at a loss. Practical takeaway: protect yourself by avoiding speculation. If you want to gamble with investments, use only a very small portion of your portfolio, say 1% or 2%. Treat it as entertainment, not wealth building. The real wealth comes from safe, steady growth, not risky bets. Principle 3, think long-term. The third principle is perhaps the hardest to follow. Always think long-term. Compounding, the magic of earning. Returns on your returns only works if you give it time. Albert Einstein supposedly called compound interest the 8th wonder of the world. Whether or not he actually said it, the point is clear: small gains, repeated consistently over decades, turn into extraordinary wealth. Let's look at an example. If you invest $10,000 at 8% annual growth, after 10 years you'll have around $22,000. Not bad, but after 30 years, that same investment grows to over $100,000. Time is the secret ingredient. Warren Buffett is the perfect case study. Most people think he became rich quickly, but in reality, he made the majority of his wealth after the age of 50. Why? Because compounding needs decades, not days. The problem is, humans are impatient. We live in a world of instant gratification, fast food, same-day delivery, viral trends. But investing is different. It rewards patience, discipline, and consistency. Think of it like planting a tree. If you water it daily, protect it, and let it grow, it becomes stronger each year. But if you keep pulling it out of the soil to check its roots, it will never grow. Investing is a marathon, not a sprint. The winners are not those who run the fastest at the start, but those who have the endurance to keep going steadily for decades. Common mistakes investors make. Before we wrap up, let's talk about some common mistakes that destroy wealth. 1. Chasing trends. People jump into whatever is popular without understanding it. 2. Overconfidence. Thinking you know more than you really do. 3. Short-term mindset. Expecting quick results and selling too soon. 4. No diversification. Putting all money into one stock or one asset. 5. Emotional decisions. Letting fear or greed control your choices. Avoiding these mistakes is just as important as following the 3 principles. Practical tips to start investing safely. So how do you put this into practice? Start with knowledge. Read, study, and learn about different assets. Begin small. Don't risk everything at once. Focus on what you know. Expand your circle of competence slowly. Automate savings. Set aside a fixed amount each month for investing. Review annually, not daily. Avoid the temptation of constant checking. Remember, the goal isn't to get rich quick. The goal is to stay rich and get richer steadily. Let's bring it all together. The 3 principles are simple, but they're powerful. 1. Never lose money. Protect your capital first. 2. Stay within your circle of competence. Invest only in what you understand. 3. Think long-term. Let compounding work its magic over decades. Wealth isn't built by luck or by chasing the hottest trends. It's built by discipline, patience, and wisdom. So the next time you feel tempted to jump on the latest get-rich-quick opportunity, pause. Ask yourself, do I understand this? Will this protect my capital? Am I willing to hold it for 10, 20, 30 years? If the answer is no, walk away. Because in investing, sometimes the best decision you can make is to do nothing. Wealth is a journey measured in decades, not days. And if you follow these timeless principles, you'll find that slow, steady, and patient always wins in the end.